Asset tokenization is the process of converting the ownership rights of a real-world asset into a digital token on a blockchain. Think of it like this: in the 1600s, if you wanted to own a piece of a trading ship, you had to buy the whole ship. Then came the invention of the stock certificate, a piece of paper representing a slice of the company that owns the ship. Suddenly, you could own 1% of a fleet. Tokenization is the next evolution of the stock certificate, instead of a paper certificate. Managed by a lawyer and a central clearinghouse which takes 2 days to settle and costs fees, you have a smart contract on a blockchain which settles in seconds and cuts out middlemen. The asset, a building, a barrel of oil, a painting, a private equity fund share, or a US Treasury bond. The token, a line of code representing fractional ownership of that building. The result? You can now buy 1/100,000th of an office tower in New York from your phone, just as easily as you buy a stock on Robinhood. Why is it a $16 trillion opportunity? The $16 trillion figure is not arbitrary. It originates from reports by Boston Consulting Group (BCG) and Citi GPS, which project the market size for tokenized illiquid assets to reach $16.1 trillion by 2030. This number isn't about creating new wealth out of thin air, it's about unlocking value that is currently frozen due to inefficient infrastructure. Here are the 4 economic drivers that create the $16T value. 1. Unlocking the illiquidity discount, the biggest factor. Currently, huge swaths of the global economy are private markets, real estate, private equity, fine art, infrastructure debt. These assets are valuable, but you can't sell them quickly. Because they are hard to sell, they trade at a 20% to 30% discount compared to public stocks. Example, a commercial building might be worth $100 million, but because it takes 9 months and 6% in broker fees to sell, its liquid value is effectively $75 million. Tokenization impact: by fractionalizing that building into tokens that trade 24/7 on digital exchanges, you increase its liquidity profile. That $75 million asset can theoretically reprice closer to its true $100 million value. Multiply that liquidity premium recapture across $300 trillion in global real estate and private assets, and you get a multi-trillion-dollar valuation bump. 2. Operational efficiency: slashing the middleman costs. The current system for moving assets and settling trades is a Rube Goldberg machine of intermediaries, transfer agents, custodians, clearing houses, DTCC, brokers, and notaries. Every hand that touches the transaction takes a fee. Current cost: settlement takes T+2 days. Admin costs for private equity funds eat up 2 to 4% of assets annually in manual reconciliation. Tokenization impact: the token is the asset. When you transfer the token, ownership changes instantly. This eliminates $20 to $30 billion annually in global back-office settlement costs and friction. 3. Democratization and distribution: the retail avalanche. There is roughly $120 trillion sitting in retail bank accounts globally, earning near zero interest or minimal stock market returns. Most of that money cannot access institutional-grade private credit deals or high-yield real estate because the minimum check size is $5 million. The bottleneck: you can't buy a piece of a toll road in Spain with $500 today. Tokenization impact: tokens allow fractionalization. A toll road bond can be split into $100 tokens. This opens the floodgates for retail capital to flow into assets previously reserved for the ultra-wealthy. This influx of new buyers increases demand and market depth. 4. Programmability and DeFi composability. This is the black magic of tokenization. A paper deed just sits in a drawer. A tokenized asset can be programmed and plugged into decentralized finance DeFi. Instant collateral: you own a tokenized gold bar, you need a loan for 48 hours. Today, you pawn the bar or sell it. With tokenization, you put the token into a smart contract vault, borrow stablecoins against it instantly at 5% April, and get your token back 2 days later. No credit check. No bank manager. No paperwork. Automated dividends: rental income from a tokenized apartment building can be dripped hourly directly to token holders' wallets via smart contract. The $16T reality check: the hurdles. If it's a $16T opportunity, why hasn't it happened yet? Because the technology is ready, but the legal wrapper is not. 1. Legal enforceability. If a token says you own 1% of a building, but the local county recorder's office doesn't recognize the blockchain, the token is worthless in court. Solution in progress. Wyoming, Switzerland, and Singapore have passed laws making blockchain entries legally definitive property records. 2. Interoperability. We have walled garden blockchains right now. A token on JP Morgan's Onyx network cannot easily move to Goldman's Canton network. For the $16T to materialize, we need a unified internet of value. 3. The Oracle problem. How does the blockchain know that the building in real life didn't burn down? This requires trusted third-party data feeds oracles that are still centralized.